Good morning, everybody. Welcome to the Flow Show. Not sure what day it is. I didn't know what day it was last night. Anyway, lots of fun and games going on. Long old day. Where do we begin with this one? Morning, Kay. How you doing, mate?
Ryan, everybody. Pre-Friday we are. Pre-Friday.
Pre-Friday. Yeah, I spent most of last night thinking it was Thursday. It felt like it was Thursday anyway. Yeah. Busy week. Right, let's get stuck into it. Obviously, lots to talk about yet again. So let's have a look what's been going on. We're going to start with the data, I think. We'll start today with the data. What's come out so far. So if you some pieces. Swiss CPI looking a bit hot there. 1.4%, bit of a surprise jump higher than expected. Core, which is not on there, also going up to 1.2 was estimated to go down to 0.9 from 1%. What's going on over there, mate?
Well, it's quite funny because Jordan said that it may be a bit of a bumpy ride, but the market got clearly surprised by it. Yeah, this is probably part of the bumps, and you know what? I mean, everybody's short Swiss, right? We know that, and that's where this move comes from. If the market would have been long Swiss or neutral, we may not have seen too much of an impact. But the market is short Swiss, and that's what we are seeing now. We need to probably clean out a few of those who are short Swiss at too low levels. So this is what's going on now. I'm still based long Euro Swiss because the overall picture, once we clean this one out, I think hasn't changed too much. But in the meantime, we have to be a bit careful here. So I'm not adding to anything. I let some go the other day above 98. Bought it back yesterday, but then I sold it this morning for some obscure reason of trying to be conservative, and it happened to be a pretty decent trade then. But yeah, as I say, bumpy ride. Call it sticky as in the rest, perhaps, but on a Swiss level then. And that's about it. And then afterwards we had this. The retail sales were a bit soggy. That is still where the Swiss companies are still complaining about stuff as well. But yeah, clearly that CPI number spooked a few. And if you look at it later, we had a very weak manufacturing PMI, but which is not taken up on the calendar again. We had a pretty high jump in the services, going from 49 back up to 55 or so. So we can't find any reasons to sell Swiss in there as well. So I'd say a bit cautious. Wait for a few more to let go, I reckon.
Yeah, absolutely, mate. Absolutely. Right, looking at some of our data because we are getting the final manufacturing PMIs also through Europe, as you can see there. Still all in the negative. Spain with a decent improvement. They seem to be pulling out in front of the green shoots stakes at the moment. But for the rest, Italy went backwards. They fell back into contraction by quite some margin. France improved slightly over the flash number. Germany improved slightly over the flash number. In the majority of details, though, price pressures remain. And despite that German number being green, some of the comments and analysis underneath the hood points to things not looking very good still in Germany. So, yeah, it may look good on the green number there, but it's not looking good underneath either. The pan Eurozone number there coming in 45.7 over the flash 45.6, so a bit of an improvement on that one. I'm just going to look back quickly at the US data stuff we got yesterday, and still keeping an eye on this mortgage number in the NBA, still creeping higher, 7.29. Janet Yellen's been bemoaning the difficulty for people trying to get into the housing market due to the high rates and costs, and these are seemingly keep going higher. So that situation is hardly likely to improve at all, and it may be something, again, being in the election year, they choose to do something about, and maybe put a little bit more pressure on old Powell over there at the FOMC. Now, one thing Yellen did get from Powell yesterday, and I won't go right into the FOMC stuff just yet, but their move on QT, reducing that by more than a lot of people expected, has effectively given Yellen an easier ride in Q3 with all their issuance, gross issuance that they may have had to done. A big drop there, which obviously has some ramifications for yields in the bond market, but it's a big relief to her that she may not have to borrow as much in Q3 or issue as much in Q3 as previously thought. So that's one favour Powell did her last night, but we'll talk about that in more detail shortly. ADP yesterday as well, nothing to see here, healthy looking 192k. This one, we know it's a bit of a flaky number, but you only look at it if there's a huge variation. You know, if that had come in at plus 400 or something, or 50k or minus 100, the market would have taken notice. If it's there or thereabouts, then we move on quite swiftly. We've got the PMI, the final S&P manufacturing PMI, which improved over the flash number by a pip, moved into expansion just about. And then we got the ISM, which was a bit all over the shop. That moved into contraction, new orders falling heavily. Employment improved a tiny bit, but still in contraction. And we got a huge jump in the prices paid number there, 60.9. A few people looking at this and saying it's maybe energy cost influence there, the rally in oil and whatnot. But the details underneath, again, suggested that price pressures still remain there. And it was a very mixed bag in that. So a bit of a wobbly one for that one. Jolt came in much lower than expected, so perhaps indicating some further softness coming into the jobs market. Again, we've had people questioning this data over its accuracy, its the size of the survey and whatnot, and some economists and people are having meetings with the BLS to try and sort it out. So if they don't like the numbers, move the goalposts, but they are what they are. We also had the US quarterly refunding for the next quarter for Q2. All came in line with expectations. No increase to what was expected in terms of how the amounts that are going to be done in Q2. That again was a bit of a relief, and as I say, there's a bit of further relief coming in Q3 anyway. So, okay, nothing really to see on that front from the quarterly refunding.
Well, no, I mean, the details were sort of as expected, right? So I guess we can move on. They will still need to borrow quite a bit of money, and a bit more than what they had expected. But yeah, then Powell has given Yellen a bit of a helping hand yesterday on the QT side. So I wouldn't go. Well, I wouldn't really expect anything spectacular. It all depends how the market views what's going on in the economy, inflation, jobs, and then the yields will decide how easy or how tough it will be for Yellen to borrow. So in the immediate, I don't see too much moving or something that we can really look out for or take an advanced position on the back of anything there. It's really going to be an ad hoc event every time that they will issue their bonds, right?
Yeah, very much so. It's probably something that the market won't be looking at in too much detail as it has been previously. Right, BOC's Macklem says they're getting closer to being able to cut rates. Says looking ahead, he expects core inflation to continue to ease gradually, and data since January have increased our confidence that inflation will continue to come down. So he's getting some confidence, unlike Mr. Powell over at the Fed. Rates unchanged as expected. A couple of notes in the statement saying there has been a lack of further progress towards the 2% inflation target. As mentioned, they will slow the decline of the balance sheet runoff by cutting Treasury redemption cap to 25 billion from 60 billion. That's going to start 1st of June. They're going to keep the MBS cap at 35 billion and reinvesting the excess into Treasury securities. They said the Fed does not expect it will be appropriate to cut rates until it has gained greater confidence inflation is moving sustainably towards 2%. With risks of achieving employment and inflation goals have moved towards better balance over the past year. That was a change in language to are moving into better balance. So have moved toward better balance rather than into better balance. A little bit of subtle change there. The Fed vote was unanimous. And why this matters at the moment, it probably doesn't really matter at the moment, but it may start to matter moving down the line because, you know, we've seen the likes of the Bank of England, you still get your outlier doves at the ECB who want to push for earlier cuts. No one is dissenting against the action taken at the moment. We're not even getting any of the big doves trying to, or even the hawks on the other side trying to push their case. So the Fed are all in line on this one at the moment. If we start to see dissension, that means we may be in for a bit of a change in thinking from some of the Fed members. Anyway, on to Powell. He said further progress on inflation is not assured and the path is uncertain. Inflation data received this year has been higher than expected. And so far, the inflation readings have not given us that greater confidence, meaning cuts. It's likely that gaining greater confidence will take longer than previously expected. He said, and he went at great pains not to utter hikes or even insinuate that hikes are a possibility all through this. But he did do a bit of a flip-flop show between some dovish lines and some hawkish lines. For example, he said, we're unlikely that the next policy rate move would be a hike, but we're focused on how long to keep policy restrictive. He said he believes policy is restrictive and weighing on demand, but during that bit of banter, he was pushed on whether policy was sufficiently restrictive, which, as we know, is language that's been used by other central banks to signal the end of rate hikes. So on that sufficiently restrictive question, he said he believes it will become sufficiently restrictive over time. That's a little bit of a nod to they're not the door is not firmly slammed shut on future hikes. Then he added to hike, we need to see evidence policy is not sufficiently restrictive, and that's not what we see now. He said policy is well positioned to address the different paths the economy might take. He said there are other paths which could point to rate cuts or like gaining greater confidence and an unexpected weakening in the labour market. So again, sticking on the cut side of things, but then said the data will have to answer the question if this is the peak rate. He was asked about the potential of 3 cuts still this year and said the Fed needs more confidence on inflation and didn't see progress in Q1. He's unsure how long it will take before the Fed can cut rates and reach that greater confidence, and says when we get confidence on inflation, rate cuts will be in scope. He said he didn't have great confidence either way on whether there would be rate cuts this year. He also questioned his own forecasting prowess, saying he wasn't sure of his own forecasts for rate cuts. So, as I say, a bit flip-floppy on in between it, but not definitely not moving into the hike side. Then a little nod to jobs data and maybe to Friday's data. It says that labour weakening would have to be meaningful before they look to cut rates. So not one bad apple will spoil the barrel. As much as if we do get a stinky NFP or the jobs market turns, it's going to take more than one number to get the Fed changing its mind. Might not be the case for the market, but as I've been saying, we will need to see a trend in weaker jobs rather than a one-off print. As for the market, it went flip-flopping between pricing September to November for the first cut. We're sitting around the September area now for that first cut, but it changes like the weather. Goldman still expects 2 rate cuts this year, starting in July and the next one in November, or the one after that in November. The Fed outcome also changed UK rate expectations, which now fully price in a September rate cut. That came after the meeting. All right, before we go on to the second direction, Kay, let's just talk about the FOMC and your thoughts.
I thought you were going to do the whole press conference for a minute. I was actually starting to doze off. Well, look, I mean, he's done his same own self again, right? But he, as much as the market or reporters would like to write a big story, he has not pivoted yet into a real hike possibility, right? I think it's still, he would hate to have to hike. And that is still filtering through in this meeting to me. And we, as I was talking about this possibility, he did put the firm plan of QT, QT tapering on the table. Put a date on it, put the amounts even slightly higher than what the market would be expecting. But again, I would like to add that even if they taper the QT, it doesn't mean that they can't change interest rates, right? So we have to differentiate a bit. It's making things a little harder. It's sending a signal that they really doesn't want to hike. But it's not a conditio sine qua non for against hikes. So we have to take that. And then he walked both sides. I think where the market was positioned for him to leave the door wider open for a hike. Okay, so the first reaction was a bit of a yo-yo one. And then the yields finally started to follow lower because the market is just positioned that way. And so that's it. Here we are. We are still looking at the same differentials. We are still looking at same data everywhere. So. Yeah, I'm going to say ball back in the middle on and here we go again.
Yeah, very much. I mean, the market was looking for hawkish, as we know, so there was a bit of a washout reaction. It's not been huge, as we can see from 2 years here. We've just sort of gone back in the box. I think he left enough breadcrumbs for hawks about hikes without actually leaving the loaf on show. Just some of those little lines and talking about paths and the data will decide whether it peak, that sort of thing. So they've got to retain that optionality. Obviously, they're not going to shut the door to anything, and they've got to cover their arse. But he obviously wasn't enough for the market on that front. So the presser ended. I disappeared to get some dinner. I came back about 45 minutes, and 4 minutes later, all hell was breaking loose. Because again, we look like we've got some intervention. It looked quite sharp on there, but it was a different story watching it live. It was happening. It was really a fun show. You know, it didn't go down in a straight line. Far more liquidity than there was on Monday. I mean, obviously in this trade, you know, 154.80, 155.20, 154.90. It was really getting hammered, and you know, there were plenty of buyers around during this. A strange time though, Kay. I mean, a lot of people have been looking at this and saying, yeah, well, the timing was good after the Fed, that twilight zone between the US closing and Asia opening, and front running, but still, you know, we didn't have the volatility. You know, it wasn't as if dollar yen was shooting back to 160 after the FOMC, and you know, it's given back over 300 pips from you know, looking at the buy today.
Okay. Just first, because I thought we were still talking about the FOMC and you were going to say something else. The fact also that I'm saying he didn't pivot, he did repeat what he said a couple of times before already. He's sending us now to the second part of his mandate, and I really persist and think that the jobs market is going to not completely take over from inflation, but the really going to be extremely important. And I just wanted to stress that again, that tomorrow I think we can have the real secondary reaction post FOMC. You see what I mean? If that job market continues to defy the laws of gravity, tomorrow I think then your dollar is probably going to shine again. Versus most, but if in turn we're getting a weak report, which of course, I mean, one day that will be the right call, that the job market cools down more, especially if they keep the interest rates higher for longer, etc., etc. But for the time being, we're not there. But if we get a weak report, then I think you will see the secondary reaction in the bond market as well, because I do think that some of those pickies who said there were short risk and short bonds going into the FOMC because they thought that he had to be much more hawkish than that. I think a part of them may have thrown in the towel, the weaker ones, but the ones who want to hang on to something are probably going to wait until tomorrow. And I just wanted to reiterate that I really think tomorrow we could see a big move on that FOMC, and FX will be a follower of fashion probably, but I mean, I'd really very, very carefully watch the bond market tomorrow after the NFP, because that's the real secondary move, I think, after the FOMC. Okay, proceed.
Yeah, well, I mean, that's another question for this intervention. You know, why would they intervene now when you got a big data point tomorrow? You know, if it comes in good, you know, a really strong number, we're going back to 156, 157 again.
And what if it's but what if they know the number already?
Well, that's a two-sided thing now. And I said it last night. You know, if the number's stinky, have they had the heads up and hence why they've moved? Or conversely, you know, you think about it, if the number's good, have they front run it? So, and then again, why are they trading data points with intervention? There was one point last night, it was breaking down, and I was thinking, if, you know, I was watching it go through 153 and whatever, and I was thinking, well, maybe, like you've been saying, maybe they want to knock this under 150 and set a bit of a level there. But if they didn't do it, if they didn't make this intervention stick at this time of night, what are they going to achieve? And I just don't see what they've achieved with intervention yesterday.
Yes, because we are not in their head, Ryan, and I don't know for sure either. But if this is a preparation of, and if this is to prove a point, I would not at this stage, right? I would not even rule them out if they come in tomorrow on a week NFP and then go and push it on 150 and keep it there. I think it's a real possibility now, because they should not have intervened, or not that they should not have intervened. I mean, in theory, we went 300 points up from the lows, right? Well, more than 300 points up from the lows the prior day. We went down to 154.5 or so. and we went back up to close to 158. That's still those famous 300 points from low to high have been done, but usually that wasn't Kuroda's 200-300 points that he meant. He meant like start at 155. If he goes up to 158, it's 300 points, let's say. But start at 155. If it first goes down to 154 and then goes up to 157, for him that would have been 200 points. But those they seemingly want to prove a point somewhere, and that's where it gets tricky. It really gets tricky now, because imagine that we get like a as expected number, and so tomorrow we're starting to drift higher again, okay? Because I mean, US data are still good, because the as expected number is going to be understood as a good number, right? I mean, if you print, what is it? 250, 240. If you print 240K, I mean, your average is still very high, especially if they manage to keep the unemployment rate well below 4% as well. So if they don't do the thing tomorrow, then I'm going to really scratch my head if it goes up again, you know. So now I think they really want to make the speculators think twice about doing something, and really at the same time get us all confused, you know, about what their real actions is. But
they've done that all right.
But if in turn we see a bit of a weaker data, and because Canada said that the yen is still at levels where they don't like it at all. So I mean, they seem to have abandoned something about the speed of things, and saying like, well, now we are talking about the levels. And they will also have seen that when the dollar yen moved up again yesterday, those yen crosses were all moving up and up and up, right? And I think it's a bit of a combination of everything. But tomorrow is going to be a huge day to know what they really want to do. And they are on holiday tomorrow, and on Monday. Okay, Canada already said it doesn't matter, but I think it will matter. It will matter what happens tomorrow. It will really matter.
Yeah, it's like you say, they if they don't do something tomorrow, they risk wasting what they've done today. But is it just a message to say we can hit you any time? Have they made a bit of a rod for their own back if they don't come in tomorrow? But you know, we're all sitting here confused. You know, Derej, he's sitting there. They totally confused us. We're all sitting here confused. Maybe that's their intention, just to confuse anyone, keep everyone on the hop. You know, no one's going to be rushing in. What I would say though is that, as you can see, after that first intervention Monday, everyone's a little bit less willing to jump straight back in. Yeah, we had a decent rebound, but you know, we had another attempt down at 155. Then we just gradually crept higher. This one looks completely different. Everyone seemed to have piled in down the bottom here and drove it all the way back up to 156 without you know, really blinking. So there's a battle going on here. People are still happy to hoover up the dips and hoover them up in this episode quite significantly. So yeah, I tried fishing around a little bit yesterday with a few shorts when it crept back up, but they got put to the sword. And I was long a bit post or during the FOMC presser. Nothing big. I wasn't going to put my house on anything at the moment, so I lost a bit of money on that. But I'm back on my hands. I'm leaving this well alone for now. And again, that's probably what they want.
You know what? I'm really thinking, Ryan. I mean, and it's just a psychological thing. But I really don't want to rule out this possibility that they would even intervene on a weekend number and try to push it under 150 tomorrow. So I think I may just buy a very short-term put. I don't want any cash, because this thing, as we've been saying and as you've been saying, we could trade 157 or 153 for absolutely. I mean, on data then for one, but then on whatever the speculators want to manage their books. I think some of them have been chased now in a way, and I think a lot of people are sitting a little on the side, which may make it even easier if they really want to push it lower, right?
Yeah.
And I just may have like, but I'm not going to risk any cash. I'm just perhaps going to buy a put into next week or so, and see what happens, if we can make money out of that. But yeah, I think this yeah, it's a real possibility that because nowadays they put enough doubt in the people's mind to for them to come in tomorrow and go like, well, we are 150 offered now. You do whatever you like, you know.
Yeah, exactly. I mean, it was even hairy right after that move. We had this, you know, in a quarter of a minute. It was up in 155 and then bang, slammed down to near, you know, low 154s and back again. And then again it happened. You know, this was after things had calmed down. That's how jumpy and volatile this thing can be at the moment. So if you are trading it, be very, very careful with what you're doing. You know, yes, it always looks enticing. You want to try and catch a move here and catch a move there. But trust me, when you're sitting there live watching it happen, and you're thinking, do I sell it here? Do I sell it here? Do I sell it here and try and catch it? And then the next thing it's down here. And then you're worried about buying it. And so it can, when you're watching it live, it's very funky because you don't know where it's going to stop, what it's going to do, and who in fact is doing it. Is it going to be, is it actually intervention? Is it not intervention? Is it just a large unwind of something? Who knows? We're all in the dark a bit.
If the amounts are right, that's already a pretty decent bit of money that they've thrown at it, right? You take the 30, 35 one day, another 20 or so, 20, 25 yesterday. We're already at 2022 intervention amounts. Which makes me think.
They said, sorry, mate.
Yeah, which makes me really take into account the possibility that they will go hard this time to curb speculation.
Because that was the other thing. We've had headlines again this morning from people picking up Banker Japan, the accounts data, current account stuff again, as they did on Monday, suggesting that they did 3.5 trillion yen yesterday in this intervention, which seems strange because this period, although it's lower liquidity, it was still only, you know, 4:30, 4:45 in New York. It's not exactly the dead hours compared to you know, bank holiday Monday, early Monday in Japan. I would have thought they would have done a lot more in this one than they did in the Monday one, but people are thinking they've done less.
Yeah, well, it's still already a bit of a less liquid time of the day.
Yeah,
Europe's gone home. People have traded what they wanted on the FOMC. Then you're an hour later, and then all of a sudden, bingo. There was already less liquidity in there. But I mean, I'm still thinking those are pretty decent amounts. I said some. Bran is asking how many shots they got on intervention. A lot, Bran. Don't worry for them. A lot. They have their reserves that they accumulated over the 20 years prior to Abenomics. They have swap lines in place with the Fed where they can pull a lot of money out of it before they. And because people say like, oh yeah, they will have to sell treasuries. Hang on a bit. I mean, they are not. They really are not yet there. I think to have to sell treasuries to cover for the dollar sales. They are not there yet. And I think not by far. They were still standing above $1 trillion of reserves, 1.1 or so. Even take 100 away from 100 billion away from that, they will still be around $1 trillion. Okay, so I mean, don't worry too much for the Japanese on the intervention power that they may have.
Yeah, exactly. Right. Well, got a couple of questions here about the Rand case. Did you want to take it this morning?
Yeah, sure. I don't know if I spoke about it on here or on the Face show. Let me. Well, I'm going to show the dollar rand, but actually, I mean, it works for every currency against the rand. I think is it Angela who asked the question about the rand?
Marion.
Sorry.
Marion.
Oh, Marion, yeah. Oh, Marion, I think a lot has to do with the upcoming elections, right? Um, we've had some okay data, but not this kind of data that would spur these kind of moves. There's been a little bit of a weaker dollar. We have seen equity markets after taking a dive, holding up a little bit better. Okay. Because the rand is also a bit of a risk currency. And then you have those upcoming elections at the end of this month, I think. And of what I've read, the commentators on those elections are looking at a potential coalition which they would view as relatively positive, or at least having the potential of being a bit more positive. So where the market likes to trade the rand from the short side, I think in the political side of it, we may have to be a little bit careful. I haven't seen really anything in data or so that would justify a much stronger South African rand. But when politics take over, when politics take over from fundamentals, we have to be a bit careful, because investors can shift their portfolio for very little reason on the economic side. Okay, we have seen that Eskom also hopes for the electricity cuts to be reduced. Usually that has a little bit of a potential of a positive impact, sorry, on the rand, but I think that it's more the political side of things that are now starting to take over from that side. If you and especially I think if you look at and I see Angela talking about the metals, especially if you would say, and that's where I say that sometimes those correlations are a bit wonky. Usually with metals lower, rand should not strengthen. So that's where I think that the political side is a bit taking over from where the data and the economics tell us right now. And I think that's behind what people are doing now in the rand. If you look at it a bit more positively, if you are a bit more confident on what's happening there, then it's a bit logic that the rand would strengthen. But if you look at the dollar rand, we're still within this bigger triangle, right? So keep an eye on 1840, 1847 on the downside, and then you transpose it to your euro rand if you want, because your the euro dollar is seemingly pegged around 107 right now. Okay, yen. Just looking at the a bit of the bigger picture and the risks to the downside. Okay, and I think the risk to the downside is still here, right? 152. 150. You can add a bit of this trend line if you want to go a bit technical. The prior low here, that's 152.6580. But that's I think the zone. If they get it below and keep it below, perhaps this market turns around. And then you add a bit of a trend line here, which comes in around 151. But obviously, you can draw all lines that you want, and you can look at all pictures that you want. And there's going to be one big psychological effect if they manage to put it below 150 and keep it there. Okay, then we will need to rethink our at least our medium term approach to the yen, because that's going to impact all of the yen process. All right, we have to look at the Swiss this morning, yeah, because we had this bit of a surprise on the Swiss CPI, and as I was saying, I think here we had this bit of a level. I had taken off a bit of my longs managing the book, And then I was planning to reload, starting to reload from here and then all the way down to 96.75. But this CPI and the observation about the positioning makes me a bit cautious right now. If we start to get below those small prior lows that we saw here end of April around 97.5, here again 97.5, we started to find bids on the last round there. Keep an eye on what's happening if we get below, because it may be that there has to be a bit more position squaring to be done before this round is over, and then I would look back at this bigger level, right? 96.75. That's where I'm, if nothing else changes, where I'm going to get really interested again. And I think similar happened on the dollar Swiss. You know, I was talking about this this level here, whether it was good enough for government work, and then about the importance of the 91.40.50. And when the CPI came out, we were trading right above, and then it dropped through, and in a decent fashion. Now there are supports, okay, and it's a bit similar as the Euro Swiss, obviously, because your Euro dollar is in a range. 90.85, 90.40, 90.25 are the big levels. But then looking forward to tomorrow, if we get a good report, then I think this stabilizes at least, and then we will see whether the portfolios have been rebalanced enough, yes or no. But if we get a bad report, I think those Swiss shorts may try to run for the exit, at least temporary. And I would really not exclude a revisit of 89, 88, 90. And that's going to be, again, a big level, because we have seen it on the way down. We have seen it on the way up several times. Once we've broken, really, it's gone. It's gone flying, and we never look back. So if ever tomorrow we get a really bad report, keep into account that this is a possibility. It's far away. It's 200, more than 200 points away. But when a market is positioned, never say never. That's we always have to expect the unexpected. Okay, so I really say never say never. What else are we looking at? You know, Brand wants to look at the cable. I know you're dying to look at the cable as usual. Still the same levels. Still the same levels for me. 125, 50, 70. All right, 50, 70, 125, 50, 70. Then a little bit more. There's a good few levels on top, but then I think if we get a crack at 125, 90 figure and we go above, it may run a little bit. And on the downside, we're turning about around a bit of a neutral level here. And I would say where it stopped last time, I have the zone here, 124.55, 124.70. That is where it should hold. If not, but I think this one, I'm not sure that I want to really take it into account, but it comes at around the prior lows here. Then we're looking at the low 124s. I think if anything big on the sterling, negative or positive, and Ryan, I don't think you mentioned, did you mention those local elections today?
No, I was going to mention it once you've done it now.
So Ryan's going to talk about those local elections. But if anything goes like pear-shaped, really pear-shaped, yeah, then look at really what's happening in the low 124s. And but I'm not sure that we can even get there on today's stuff. The market is still remaining very, very quiet around the 85.5 on the euro sterling, and the dollar is doing its little thing rather than the sterling right now. Back over. Oh, metals after the FOMC. Metals after the FOMC, yeah. I've got a bit of support coming in around 22.75, low 22.80 on gold. But the top side really is still the same. There is it is 23.20 up to 23.26. So we are looking at 40 bucks, 40, 45 bucks range here. And then you have to see what happens. I would argue that this here around 22.5, this is where it's decision time, because if it starts to go back down here, we are going to start looking at different patterns unfolding. All right, so 22.5, keep a very close eye on that one. Okay, and silver is actually having a harder time to rebound because we are below 26.20. Oh, really? I mean, let me have a quick look at this one here. Oh, Mr. Stelios will have had this his little silver leg here. I'm still rather looking before I do anything more around mid to low 25s here in silver. Retest of there, and I'll probably try to load some up. But I'm also thinking to just wait for the NFPs and see what the report is giving us tomorrow. Especially that the market feels a little bit nervous now about it on certain stuff. And with that, Ryan, back over to you.
Thank you very much, sir. I'll just grab it quickly, just a couple of bits and pieces. You didn't cover oil, did you, Kay?
Hmm?
You didn't look at oil, did you, in that lot?
No, I didn't.
No. So, yeah, we've got a bit of a break in US oil below this 80.50 level. That's been a bit of a player going on for quite some time around that area. So, a bit of a breakdown yesterday in that, which is going to help on the inflation front, at least for a few people, if it lasts, and that won't come through for a few months' time. So, yeah, it's a bit soft in commodity land as well. Now, onto these elections, I doubt it's going to be anything for the pound. It's more for implications of the general election possible result. They're local elections, they're mayoral elections, so just for mayors. They're not even parliamentary seats or anything like that. There's only one by-election going on for that. There's 107, so it's not the whole country that's doing this, but it will be looked at in terms of results for the ruling Conservative Party, as I say, going into the election. It may stoke more talk or greater talk about when the general election will be called. But as I say, I don't think there's going to be anything too much for the pound to trade on that. But we won't get the results until start coming through till late this evening and all through the early hours and into tomorrow morning. So it won't be until tomorrow until we get a better idea of what's going on. But just so you know, that's what's happening. And don't forget to vote for Count Binface if you're in London as the mayoral candidate there, the good old Count Binface. Right, we shall call it a day on that note. Take care for the rest of your data, for the rest of the day, sorry. Watch that data.
Vote for the NFP comp.
Vote for the NFP competition if you haven't already. You can find it on Twitter because I can't be bothered to scrabble around for the link to put in the chat. Have a good day, everybody. Thank you very much, K-Man, as always, and we'll see you tomorrow for NFP Friday.
Thank you, Ryan. Thanks, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.